Every international brand begins as a local experiment. For many, it starts with a single founder, a leased storefront, and the very first espresso shot of a busy morning. At this stage, the business exists as a sole proprietorship. Under this legal structure, the law recognizes no distinction between the founder and the business. They operate as a single legal identity with a shared set of risks. This unified identity dictates the financing. In the startup phase, the founder retains total control over every daily operation, but they must also provide every cent of the capital. The funds to secure the lease and buy the initial inventory come from personal savings, credit cards, or individual bank loans. This is the initial balance of business. The founder enjoys absolute decision-making power at the cost of carrying 100% of the financial burden. Success eventually pushes the shop to its physical limit. Scaling from one location to 10 requires a volume of capital that far exceeds the founder's personal net worth, creating a bottleneck for growth. Expanding under the current structure exposes the founder to unlimited liability. Because the owner and the shop are legally identical, the owner is personally responsible for every debt the business incurs. As expansion costs grow, the risk profile shifts. That small stack of personal capital is tethered by a direct legal line to the founder's private assets, their home, their car, and their savings. Startups often lack the hard collateral needed for favorable loan rates, making traditional debt expensive and dangerous. If the new locations fail, creditors hold the legal right to seize the founder's personal property to settle the business's debts. To grow beyond the limits of personal wealth, the business must evolve into a different legal entity that separates the individual from the enterprise. The business has now expanded into multiple districts, signaling a change in its legal DNA. It has left the sole proprietorship model behind. The company is now a corporation. It is a distinct legal entity with its own rights and obligations, capable of entering contracts and paying taxes independently of its founder. This structure provides the limited liability shield. If the corporation defaults on a loan or loses a lawsuit, the founder's personal bank accounts remain protected. The risk is confined to the capital invested in the business. To gain this protection and attract outside investors, the company's ownership is divided into tradable units called shares. The founder sells these shares to venture capital funds or strategic investors to fund the next stage of growth. This move marks the formal separation between the owners who provide capital and the managers who run the daily operations. Forfeiting absolute control provides the business with the external financing needed for professional scaling. Now in the growth stage, the company sees rapid and predictable revenue increases. It has proven its model works across dozens of locations, but it now needs massive operational leverage to build a national supply chain. Because the corporation now owns physical warehouses and generates steady cash flow, its financing strategy changes. It is no longer restricted to selling equity to raise money. The company begins utilizing secured debt. Because these loans are backed by the company's new hard assets, like roasting facilities and real estate, the interest rates are significantly lower than startup loans. Management uses this secured debt to accelerate construction while preserving their remaining equity. By borrowing conservatively, they minimize the risk of financial distress while maintaining the flexibility to pivot in a changing market. Strategic debt acts as an accelerant for capturing market share, a tool that is only accessible once a company has outgrown its initial fragility. The company enters the mature stage. It now manages hundreds of locations across multiple continents, generating the significant and stable cash flow required to maintain an investment-grade credit rating. To fund the infrastructure of a global leader, the business requires a volume of capital that private equity can no longer provide. The company enters the primary capital market. This is the specific arena where newly created corporate shares are sold to the public for the first time. They initiate an initial public offering, or IPO. This requires engaging investment banks to underwrite the deal, ensuring the company receives the necessary capital by guaranteeing the sale of the new shares. The scale of the IPO is immense. Ultimate ownership of the company is exchanged with thousands of global investors simultaneously, from individual retail traders to massive pension funds. This process provides the corporation with virtually unbounded access to capital. It also completes the transition of the company into a professional entity, governed by a board of directors on behalf of its millions of shareholders. The completion of an IPO provides the permanent financing needed to operate as a self-sustaining enterprise on the world stage. There is a vast distance between the humble start of a single shop and the striking of the opening bell on a public exchange. Navigating that distance requires an evolving strategy, matching the business's legal structure to its specific stage of growth. The final evolution of a successful business is the corporate architecture itself, a machine designed to scale a single great idea across the globe.